A lot has been made about a massive transition going on in the U.S. economy, especially in light of President Trump's recent victory and the election. And that's really the idea that there's going to be a massive reshoring to the United States of manufacturing and other industry, because you have President Trump talking about slapping 10% blanket tariffs across the board on all imports and potentially a 60% tariff on Chinese imports. And what that would do is greatly incentivize companies to relocate their production to the United States, or at least certainly out of China. And so with this mass influx of new investment in manufacturing at the same time as the AI boom is going on, which is causing a scramble to build new data centers and to provide energy to power those data centers in the United States, there's a huge industrial boom about to take place in the United States that Morgan Stanley estimates could add $10 trillion to the economy in the United States over the next several years. And so this could potentially provide a huge opportunity for investors to take advantage of. And in this video, I'm going to talk about two attractive, high-yield, blue-chip dividend growth stocks that I think will benefit from this $10 trillion opportunity in the coming years. But before I get into discussing these two stocks, if you could please subscribe to my channel to get future content, I'd be greatly appreciative. Thank you so much. Okay, so what is the first one of these stocks? It's WP Carey. And I've talked about some before on this channel. WP Carey is a triple net lease REIT. It used to be very diversified, but they've recently exited from their asset management business. They've exited from some of their hotels that they owned. They've exited from their office portfolio, and they've been aggressively investing in growth into warehouses and industrial properties. To now, the majority of their portfolio is industrial and warehouse, but they still have some essential retail. They have some personal storage assets and a couple other miscellaneous holdings. But they have a strong balance sheet, BBB plus credit rating from S&P 500, with plenty of liquidity and much better laddered maturities now on their debt after selling their office assets recently and paying down some maturities there. They also have a very attractive dividend yield of well over 6% with a payout ratio of adjusted funds from operation in the low 70%. So the management has said, look, moving forward, we're going to be able to grow the dividend in line with adjusted funds from operation growth, keep that payout ratio in the mid 70s range. So they have a potentially attractive dividend growth profile. But where I really like WP Carey, especially in light of what's going on right now, the trend I just mentioned with the $10 trillion potential shift of industrial and economic activity, is that, well, two things. First of all, again, their concentration in industrial and warehouse properties helps them because it gives them expertise in acquiring new properties as growth takes place in the sector, but also that their existing properties are likely going to increase in value because there's going to be greater demand for those real estate properties. But the second thing that I really like is that the majority of their income, their rental income, comes from leases with CPI-linked rent escalators, they're contractual rent escalators. So that means every year or however long the escalators kick in, whatever the CPI is, that's the amount, or at least up to a certain cap, depending on the exact lease, that's the amount that their rent is going to increase on that property. So if we do have inflation that kicks in from, again, the reshoring of production, which is going to be higher cost than it would be elsewhere, or just simply a tariff is being applied on the import, that's going to boost their rental income. So it helps insulate against that potential risk. At the same time, they have that triple net lease structure that's very conservative, well-diversified portfolio, high-quality assets. And so if we do go through an economic downturn, if there's a big trade war or even an open conflict with China and the United States that can put a big wrinkle in the economy, they'll benefit from that still by being one of the more defensively positioned REITs. If rates fall, they've got that bond-like cash flows coming in. And so I think they're very well positioned for whatever happens, but they are leaning into traits, both in terms of property type as well as the CPI-linked rent escalators that should benefit from this long-standing and likely long-running trend of reshoring of American industrial capacity. The second one that I really like right now is Brookfield Renewable Partners. And Brookfield Renewable Partners, by the way, issues a K1 but does not generate UBTI, so it should be suitable for inclusion in a retirement account. But also, if you want to hold it in a taxable account but don't want the K1, you can invest in the BEPC shares, which is Brookfield Renewable Corporation. It's the economic equivalent of Brookfield Renewable Partners, but issues a 1099 instead of a K1. Of course, it is more expensive. For that benefit, a lot of institutions invest in it instead of BEP. So keep that in mind as well as you make your decision. But no, none of that's tax advice. It's just my own personal experience and understanding of it. But again, do your own due diligence before buying any shares or units of either BEPC or BEP. But why do I like it? Well, as its name implies, it produces renewable power. But it's a yield co. And so it has primarily hydropower that's strategically located, but also has wind, solar, and it also is engaged in battery storage and nuclear, and owns a stake in Westinghouse, which is a nuclear reactor technology company. And so it is well diversified across clean energy technologies, and it is well positioned to benefit from this reshoring and ongoing AI boom in the United States. And the reasons for that are simply that, well, first of all, when you have more industrial capacity and more economic activity, that requires more electricity. And so there is a demand for electricity, and it's an electricity producer. And so demand is increasing for what it supplies. But additionally, nuclear power is really taking off right now. You see a lot of companies are saying we want nuclear power because it's cheap, it's clean, it's very reliable, so it's a great source of power for data centers, for example. So Westinghouse is poised to, it is already is, but it's going to continue benefiting from it. In fact, even China is buying some Westinghouse stuff. And then you have a large contract that they recently signed with Microsoft to power their AI investments in the United States with renewable power. That's a huge contract that should provide them with some good growth, and they expect more of these contracts to come along. And so again, they're very well positioned for that side of things. But also, they, like WP Carey, have a very high percentage of their cash flows are indexed to inflation. And so, again, if we see inflation go up from the increased costs of investing in industrial activity in the United States and trade friction through tariffs, et cetera, their revenue will benefit from that by their CPI linked escalators on their power purchase agreements, these long-dated contractual cash flows on their assets, which also make them a very defensive investment in the event of an economic downturn. So again, like WP Carey, they're well positioned for just about any environment. I also really like that they also have a BBB plus credit rating from S&P. They pay out a distribution yield well north of 5%. It's been growing at a mid-single digits rate annually. They expect their cash flows per unit, though, to grow at a double-digit per unit CAGR for quite a while to come. And so when you look at both of these, WP Carey and BEP, Brookfield Renewable, they are well positioned for what I see as this $10 trillion opportunity that Morgan Stanley talks about with the reshoring and potential inflation that could come along with it. Again, it's also important to note they're attractively valued. In addition to their yields and growth potential, WP Carey trades at a discount to its net asset value currently, despite historically trading at a premium to it. And BEP, again, when you look at their attractive growth plus yield, it looks like a double-digit yield. And on top of that, they're trading at a discount on a price to adjusted funds from operation basis relative to their own history. So again, if you found this video useful, if you could please give it a like, subscribe to my channel so you can get future content and I discuss additional dividend ideas, I'd be greatly appreciative. Thank you so much. See you next time.